so 15.4 is on calculating federal income tax. We know that the entire chapter on 15 has been preparing and calculating adjusting entries, because when we make our trial balance, we make it for the year and then we have to go back and we have to update it, right? So federal income tax, a lot of times businesses, they're going to be set out on like quarterly payments. So they'll take their income from last year, and their accountant or whoever does their financial statements will look at it and they'll kind of predict what they think they'll make for the coming year, so that they pay their taxes in quarterly. If any of you have got a paycheck and whatnot before, you know that you get federal income taxes withheld from your check. Well, businesses, when they're making that money, they're not paying anything in on taxes, right? So at the end of the year, they have to pay all their taxes in because nothing has been withheld. So usually they set it up on quarterly payments so that they pay in throughout the year. And so if that company says, okay, I'm going to pay $25,000 a quarter in, but then they get to the end of the year and they owed more than $20,000, then they have to go back and pay that remainder and then go do their adjusting entry. So that is what we are learning about today, because everybody has to pay federal income taxes. Unlike like corporations, entities, they have obligations of an individual, but corporations, they must pay everything, but must pay federal income taxes. So the first thing it's going to have you do in this chapter is go through and post your adjusting entries. That's really easy, right? We just look at our general journal and we post each one into their own accounts. We have did this all year, right? So we look at the journal and then we post them, and I will get to that. So to figure out the taxes, what a corporation must anticipate that they'll owe, there is a tax rate schedule. I don't know when this book was made, and I'm sure it's about the same. So they have it broke down. So like this company, if they make under 50,000, then it shows what they're going to pay, and then it's going to show the percentage of anything over 50,000. They have 25%. Anything over 100,000, then they pay the 39. They pay 22,250 plus 39% over 100,000. Or here, 113,900 plus 34% of anything over 335,000. Usually you're broke down into payments. Hey, don't be eating that in the morning, chocolate. Usually it's broken to April, June, September, and December. So like this company right here, they say they made 103,000 in our book, right? So they fall in this tax bracket, right? They made 103,000, so that's in between 100,000 and 335,000. Okay, so they know they're going to pay 22,250. That's their base rate. But they also have to pay 39% on what they made over 100,000. So over 100,000 would be 3,518.97, right? Times 39%. So they're going to pay 22,000 plus 1372.40, because 1372.40 is what they made over 100,000. So this is the tax bracket that you're going to use for your problems. This is the standard tax bracket. So now this in the book, it says this company set out quarterly payments of 20,000, so they paid 5,000 a quarter. So we know if we take 20,000 minus 23,662.40, they still owe 3,622.40, right? So they have to make the adjusting entry because they already paid in 20,000, but now when they get to the end of the year, they still owe another 3,622.40. So you got to go through and you got to write that in your journal, and then you just post them to their individual account. So federal income tax was a debit, and then federal income tax payable is your credit, and then you post them. You post them into their own accounts. So that's a lot better if they break it up and pay throughout the year than at the very end of the year they didn't owe that complete $23,622.40. And then you got to go through, and we know that unadjusted, we start with an unadjusted trial balance, and then we finish with our adjusted trial balance always, right? So the only I'll walk you through really fast the on your own, and then I'll give you some numbers. So the on your own, it tells you post the adjusting entry. So that's the first thing that we're going to do. So we know if we look at our general journal, let me get to it. General journal. This is our general journal. It's going through and it's telling you to post the adjusting entries. So we've did this pretty much all year. You just got to go through and find each account and post it. So our first one, allowance for uncollectible accounts. Allowance, so that's a debit of $34.15, right? So it goes in our, sorry, that's a credit. I got allowance for uncollectible accounts. I was looking at uncollectible. $34.15 is a credit. So we go through, we put it in the credit, and then we do our balance. If it's a credit to a credit, we add it, right? Okay, our next one, we're going to put merchandise inventory. So we're going to go look at our general journal. We're going to look for merchandise inventory. Okay, it's a debit of $1625.94. See, I'm just taking it. I'm just transferring it. So we put it in the 31st. It's a debit. A debit to a debit. We know all year we have been doing this. We add. Okay, our next one that needs post, supplies office. So we go to our general journal and we look. Supplies office. It's a credit, 25608. Okay, it's a credit. We know if it's a credit to a debit, we're going to subtract it for our balance. Okay, so we know how to do that, right? You're just going to go through all the general ledgers and you're going to post each account. You're going to get their total from the general journal and post them. Record all account balances except for income tax on the adjusted trial balance. Now you're going to take each one and you're just going to put them in their adjusted trial balance. So the first one, depreciation office equipment, to $21.50. Okay, and we get that depreciation office equipment, $21.50. It's a debit, so in our adjusted trial balance, it has to go into the debit. So just go through, you take those totals and you post them. The next thing, we have to go through and calculate the tax bracket, which we just did. It doesn't tell us that this company paid anything in. It's not worried about that. It just wants us to figure it out. So then we can go and we'll put it in. I'm just going to give you the totals. So we know total of income statement credit accounts and then our debit account. So we take it from our income summary. I'm going to give you these because I'm sure some will have the numbers off. So our total of income statement credit account for work together, $536,948.17. Our debit was $395,360.48. We subtract those two. So the net income before taxes, $141,507.69. Okay. So we know that they are in the tax bracket. We go look. Oh, where's that at? With the tax bracket of 100,000, right? That's where they fall. If they're 141,000, they fall in between the 100,000 and 335. So they're going to pay the base rate plus 39% over 100,000. So we know if we subtract 100,000, right? Minus over the amount of 100,000, because that's the tax bracket. So they will be taxed 39% on 41,589. So they get 16,209 over the base rate of 22,000 they already had to pay. Add those two. The total payable amount in federal income tax this company is going to pay is $38,469.20. And then you come over here, you post it, federal income tax expense, okay, and then you go, then it tells you to go finish your finalize the posting entry. We did that. Complete the adjusted trial balance. So you just put in what you got. This federal income tax payable, you're just gonna get those from right here, guys. We don't have to figure anything out. It already gives us that. We just have to transfer it to our adjusted trial balance to total and prove it. Okay, so I will really fast on your own. I'm gonna, Selah, don't do that. I'm going to tell you, these are your totals, so you all have them right. 775,000, 684,000, 33462. So your difference is 90,000. So we're in a different tax bracket than what before, right? Because 90,000, that falls between 75,000 and 100,000. So their base rate is 13,750, right? And then they're gonna pay 34% on anything over 75,000. Okay, so we know they're gonna pay 15,000. They're gonna pay 34% on what's over 75,000, and then their base rate was that. So, okay, and then you just go through and you post it, and everything else, guys, we're just posting from our journal to our general ledger accounts. Okay, so if it's a debit in the general journal, it says a debit in our ledger account. Okay. Let me know if you have any questions. Go ahead and complete on your own.